Hey everyone, and welcome back to another video for today. So in today's video, I do want to cover two companies that have seen their stock price go down by 45 to 50, 60% or so since their all-time highs. Now, two companies in two completely different industries and two completely different reasons as to why both of these stocks have come down quite drastically. Now, I'm just picking two. There are way more stocks out there that are down significantly, especially software names. Well, we are actually going to talk about one software name in this video, which is ServiceNow, ticker symbol NOW, now. And then the other company is called Novo Nordisk. Yes, Novo Nordisk is a European stock. You can buy it in Europe. You can also buy it in the United States in USD. So without further ado, let's dive right into this. Hit all the buttons. You know what to do. Would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And of course, all of this is made possible by the great partner Fiscal.ai. There is a link down in the description and in the pinned comment. To get 15% off, new users will get Fiscal Pro for free for the first 2 weeks. All the data, all the PE ratios, price to sales, margins, and all of that is coming from this platform right here, as you will see throughout the video. So if we look at ServiceNow right now, yes, ServiceNow right now, we look at the market cap, $133 billion. We see a trailing PE of 77.7 times, a forward PE of 44.2 times. So you might say, why are you even touching on this company since we are still seeing here super high PE, whether it's trailing or forward one? Well, good point. Okay, fair enough. Usually when we see stocks that are experiencing drawdowns of 43%, in this case, the PE is much lower. In most cases, not all. Because in a lot of cases where we look at quality companies that were always trading at a high premium, well, these pullbacks happen and it just becomes less expensive than before. Now, with ServiceNow specifically, of course, you can put it in a bucket with all the other software names that have been crushed over the past 12 months or so. But unlike many other software names out there, this is still a company, first of all, that has been growing quite rapidly over the last couple of years and is still expected to grow rapidly over the coming years. Margin-wise, of course, from a software company, you're expecting high margins, whether it's gross, EBITDA, operating, net, or free cash flow, you are expecting margins to be high up there, which is exactly what you're getting right now. Now, if we go and look at some pricing metrics here for ServiceNow, trailing PE, although there is this one time here where there was no E, so let's maybe pull it right here so we get a better picture. You can see that over the last 12 months, take an average, but we know that it's a bit lower than 80 times trailing PE. We can see that this is a stock that was always extremely expensive. Right now, it is just less expensive. If we look at the forward PE, it's a bit better here, but actually it's much better. An average of 61, actually, if we pull it back a bit more, the average here is, well, 64.8. So we are, well, 50% lower than the average for the forward PE. Then if we look at the forward price to free cash flow, 27.3 times, here as well below the average, and price to sales just under 11 times, the average here is 17. Forward price to free cash flow, 9.1, average here is 13.8. So again, it's better than before, doesn't automatically mean that it is extremely cheap. Then if we look at margins, now this is where you start to understand why people are willing to pay a premium for this company. Operating margin goes up and to the right, 13.9%, and rising. Free cash flow margin, 31.2%, has been around this area for quite a while. Gross profit margin, 78.1%, did come down a little bit over the past 2 quarters. High SBC, higher headcount, and AI infrastructure costs is the reason for that. Net profit margin, 13.7%, was a bit higher before, but those are all, if you look at the quarterly, you can see exactly where the one-time effects are pushing these numbers quite high, as you can see right here. And the last one, of course, here is cash from operating activities, up and to the right over the past 12 months, $4.84 billion. And now if we look at the non-scientific way of trying to understand what is broken and what is not, we look here at revenue and the market cap of a company or stock price of a company. And if we go back and look at 2021, of course, 2021, everything went high. And so then we saw a pullback. But what we've seen consistently is that revenue consistently goes up and to the right? This is a beautiful, beautiful chart. And so the stock did recover and the market cap went higher and higher and higher. And then it peaked and it dropped. But it didn't drop because revenue is suddenly declining, free cash flow is suddenly declining, things like that. No, here again, it dropped because it was just too expensive. And we have the question mark, the big question mark. 15 years ago or so, we've had software is eating the world. For the last 12 months or so, we've had headlines of AI is going to eat software because ServiceNow is, whether you want to call it cloud-based or AI cloud-based platform, whatever, it's like an operating system for your whole enterprise to automate workflows and all of that. And so, yes, when we have this question about AI, is AI going to amplify this business or is AI going to replace this business? Well, if you've been paying attention or not, ServiceNow, especially the CEO, which looks like Al Pacino from Heat, I'll actually pull up the pictures. This is a company that embraces AI. This is a company that's always been mentioned when there is an NVIDIA keynote. So it's not a company that's like, oh, AI, shmai, don't care about it. No, this is a company that, in my opinion, will become better and stronger with AI. It's one of those companies also that whoever uses it is not like, you know what, let's cancel all of our contracts with a ServiceNow. Let's cancel here our subscription, which, by the way, if you look at subscription growth, still above 21%. So that's growing quite nicely. It's the majority of the revenue comes from subscription revenue. Total remaining performance obligations, 24.6% growth as of last quarter. Then customer renewal rate, 97%. So you go say, oh, look, it dropped a bit. Yeah, okay, but it's always been 99, 98, 97. We've had 97 here in 2021 as well. If we start to drop closer to 90 suddenly, then yes, maybe you should start to worry. But as of right now, for the price that these enterprises are paying for ServiceNow, I think they'll continue to pay it. And if ServiceNow continues to deliver the value, I don't see why this company will be in danger. If you look at the growth rates, yes, here again, growth rates are coming down, or the expected growth rates from analysts are coming down for revenue. Free cash flow is expected to grow faster than revenue over the coming fiscal years. And so if we look at the stock right now, we are here on the weekly below the 200-day moving average. We're also oversold, and we are back here at a bottom that we've seen back in May 2024. If we look at the daily for the company, we're also heavily oversold here a couple of days ago. Then we've seen the stock rebound. We'll see if this is a dead cat bounce or not. We're of course entering the big earnings season over the next couple of days. Quite a lot of big companies are reporting, could impact ServiceNow, but then again, ServiceNow is reporting their quarterly figures on Wednesday. Moving on to company number 2, and that's Novo Nordisk. Now, Novo Nordisk, as you will see from a pricing perspective, is completely different conversation than what we just had with ServiceNow. But then again, they are completely different companies with completely different reasons as to why the stock has come crashing down. In Novo's case, now 57.6%, but at one point it was down closer to 70%. You might not know this, but year to date, Novo is almost up 20%. So if you bought it, let's say at the end of 2025 or maybe first day of 2026, you would have already outperformed the market and then some. Now, Novo is a company worth right now around $275 billion, trailing PE 16.9 times, forward PE 12.5 times, margin-wise, still quite okay over the last 12 months, actually very good. It's a very profitable company, although there are some one-time hits that they've taken, as I'll show you in a bit. The problem mainly is the expected growth. That's mainly the problem, as we'll discuss. But first, let's have a look at the trailing PE. As you can see, well below the average. So you might say, oh, okay, no brainer. If it's well below the average trailing or even forward one, it's a must buy. Well, I'll explain in a bit why that's not automatically how it works and how it should work. Forward price to free cash flow is actually very close to the almost 10-year, close to 10-year average here. Price to sales, 5.5 times, while the average is 9.1 times. And here, forward price to sales, 6.1, average is 8.1. Now, if for this company specifically, you want to look at the price to free cash flow, or in this case, the price to earnings, well, as we've seen with other companies, I think I covered Adobe a couple of days ago, you might have seen or you might have heard the reason why it deserves a lower multiple than before. It's quite easy, the explanation. It's because it is growing slower than before, and so it's not getting the same premium. Same here with Novo. As I said before, Novo previously, when it was trading at around $80 or so, what was it, 12 months ago or something like that, even 70, I said it's cheap based on what we knew. But then they issued new guidance. Growth guidance was lowered quite considerably. Suddenly, it is not cheap anymore because suddenly it's not growing as fast as we expected 24 hours before. It's a big difference. Now, if we look at margins, especially operating margins and free cash flow margins, all of that, they were quite good, actually very good, up until last quarter. As you can see, there was a one-time hit. I'll explain in a bit, but this is still a very, very profitable company. This is basically what has happened last quarter, which of course impacts the last 12 months that we've seen. So last quarter, gross profit margin dropped to 76.1%, operating margin 31.6%, net profit margin 26.7%. Now, the reasons for all of it is right here on the screen if you want to pause it, but basically one, for the impact on the stock for last quarter, I think it was the last 9 months performance that we have seen, which is basically this. We can say, oh, look, sales growth of still 15%. That's not bad. That is indeed not bad. But as you can see, the company narrowed full year guidance to 8 to 11% sales growth, down from 8 to 14, and 4 to 7% operating profit growth from 4 to 10%. They cited lowered growth expectations for GLP-1 treatments within diabetes and obesity. Then gross margins plummeted from 84.1% to the number we've just seen, driven by $9 billion in Danish kroner in a one-off restructuring cost, asset impairments, and costs from Catalent acquisition. Without restructuring costs, the 9-month operating profit would have grown 21%. Again, it's one-time things. Sometimes it benefits or sometimes it does hurt the company. Then diabetes value market share declined 2.3 percentage points to 31.6% globally. GLP-1 diabetes market share fell from 55.7% to 49.3% globally, with particularly steep declines in international operations, where it dropped from 71.6% to 56.3%. Novo also accepted maximum fair price for Ozempic, Rybelsus, and Wegovy in Medicare Part D effective January 2027, so 12 months from now, with an estimated negative low single-digit impact on global sales growth. So you want to basically understand what has happened with the stock and the company, this should be it. Now, it's not all bad for Novo, because there is a reason why the stock is up already close to 20% year to date, and why it can continue to go up. This is the reason. Novo Nordisk Wegovy pill, the first and only oral GLP-1 for weight loss in adults, now broadly available across America. The launch achieved 3,071 retail prescriptions within just 4 days in early January 2026. What we've also seen is the trend on Google search. If you look for Wegovy over the past year, you can see clearly that more recently it has gone up significantly, because before, yes, Wegovy, Zepbound, all of these things were quite popular. But instead of injecting yourself with something, if you can just take a pill, I think that should be way more successful. Well, we actually got more data on that. The oral weight loss drug introduced by Novo Nordisk this year in the United States is quickly being adopted. Analysts pointed to data from Symphony Health, which showed that weekly prescriptions for the oral version of Wegovy surged to 20,392 from just 4,286. At the same time, prescriptions for the injectable once a week were steady. Bank of America analysts calculated that the oral version needs about 2,000 prescriptions per week in order for the company to meet 2026 sales estimates. So if they suddenly get momentum from this and the market sees that, oh, we think 2026 estimates are going to be beat quite easily, well, you can already expect the stock to react positively. Then Research Plus on X here said the following thing: Australia is about to start subsidizing Wegovy for people with established cardiovascular disease and an BMI of 35 or higher. That would mean a copay for only $25, well, Australian dollars. Could also be a good catalyst for Novo Nordisk. Which brings us to the stock, which seemed to have bottomed, right? It bottomed the same area where it was here in September 2022 and even in July 2025, around $44, $45 or so. Since then, since that bottom here at the end of November, the stock is up 43%. So everyone that did buy here, whether it's call options or pure shares, bravo, you did very well. The company is also going to report Wednesday, February 4th. That's also going to be quite a busy week in the market. On the daily, we were actually overbought almost 2 weeks ago, but the stock did continue to go up afterwards. We are now above the 200-day moving average. And so all in all, that's about it. Two interesting companies, but two companies that have different reasons for their pullback or their crash in the stock. In my opinion, with Novo Nordisk, it's a company where catalysts, positive catalysts, are going to continue to push the stock higher because suddenly it will look extremely cheap if we see growth accelerating. For ServiceNow, I think it's different. It's still an expensive stock, less expensive than before, but a tremendously well-run company, a company that is growing quite fast, and a company that, in my opinion, will show the market that AI is a tailwind, not a headwind. That's about it for me in this video. Let me know what you think down in the comment section below. Check out fiscal.ai to get 15% off, and we'll see each other in the next one. Bye-bye.